Welcome to RFI's Banking Uncovered, the podcast going behind the industry PR, the media spin, the product awards, and the investor reports to look at what's really going on in the customer data, and to ask global thought leaders about their thoughts and views on the future of banking and payments.
Welcome to RFI's Banking Uncovered, where I'm delighted to welcome back Brett King, who's been a guest many times previously. Brett is a world top 10 futurist, a best-selling author, a successful fintech founder, a well-known global speaker, and it has been inducted into the Fintech Hall of Fame. But today we're here to talk about not so much AI and fintech and the future, which we normally are, but kind of disappearing down the rabbit hole a bit into the past. We're going to talk about branches, which are probably the most traditional form of banking, and the future of branches, if there is one. So, Brett, welcome to the show. I know you've got a new book out, Branch Tomorrow. So, tell me just a bit about that. And there it is. Tell me just a bit about that. And when's it out officially?
So the ebook is out right now. We're waiting for the physical book launch out of the state, but it is available in limited distribution in physical copy, but you can order an ebook on Amazon anytime you like.
Fantastic. So what was the genesis behind the book, and why did normally you're looking at the future implications of AI, of agentic AI, of where fintechs are going. As I said, you're a futurist, and it kind of feels like with the branches, they're a thing of the past.
They're pastist. Yeah. Well, I wrote a book on like the debate around branches back in 2012. It was initially an ebook. We did print it in some initial form in soft cover. It was called Branch Today, Gone Tomorrow, and I wanted to update that. Primarily because in both that book and in Breaking Banks, I did a forecast on the decline of branches in the US market in particular. But I thought, well, let's look at how branches are either increasing or declining in utilization and numbers globally, and what's the factors behind that? Why is that changing? And found out some incredibly interesting information along the way. And then it's like, we need to write this. And then of course it was a question about what future do branches have? And we get into a lot of argument in the US market in particular, because Chase is still deploying branches. And, if Chase is doing it, then there must be still life in branches. But at the same time, the top 50 fastest growing financial institutions in the world, all of the fastest growing banks in the world don't have branches. They're neobanks and they're fintechs. So, if you needed branches to be good at banking, then those banks would have failed. So that was the genesis of the topic. And we were going to call it Branch Today, Gone Tomorrow, sort of edition 2, but it became such a different book that we changed it to Branch Tomorrow. And when I say we, obviously I wrote the bulk of it, but I have contributions from Bruno Diniz, who did our Latin American research, Jim Marous on the US, Effie Pilarino from Greece, who worked with Paolo Cerrone on the EU chapter, and Richard Turin on the China chapter, which I'm sure we're going to talk about China a bit later.
We absolutely are. But let's get into the conundrum, because I think for the last 30 years now, at least once a year you can find a conference that's titled the branch is dead, long live the branches. This ever-going conundrum of what actually is the future of branches. So if we just go into the stats for a second. So from our data, we know that obviously branches dipped hugely in the pandemic because of limited, if not zero, access. They've recovered slightly to pre-pandemic levels. So in the UK, it's about 15% of the population are using them. In Australia, it's about 22% on a regular basis. In Asia, interestingly, it's up around 30%. So why is that? Is that because there's no choice? Is that because of habit? What are some of the reasons that people still go to the branch? In the research you've been looking at.
I mean, this is good speaking to a researcher about this, with RFI's strong research background. I mean, the one thing that I wanted to look at on a macro basis is, how quickly were branches declining in specific markets? Were there certain markets that were resistant to that, and why? Did that give us an indication of what's happening with the branch? The problem with the research traditionally has been we ask people if they would like a branch, and you see still a lot of research that says people choose banks because of branch location. And yet, when you look at the data, and this data is very, very difficult to find. You can only find it internally within banks. When you look at data on how frequently the average customer is visiting a branch, that's plummeting. And so as a result, because branch utility is declining, we've seen the net number of branches decline globally now for about a decade. And this is something I only found out with the research, that we reached peak branch in 2015 globally.
That's backed up with our research, but whilst there's no doubt branches are declining, banks have less branches, particularly obviously the incumbents with their huge branch networks. But there's still this, when we asked the question, we asked, have you used this in the last 2 weeks, and do you use it on a regular basis? And we're still seeing this kind of latent resistance, mainly because people say there are kind of two very different reasons. Either it's because I like the human interaction, and
Right.
I want to talk to someone about my problems or about the complexity, or at the other end of the scale, which is probably more in the US than the UK, with and to a degree Australia, with the cost of living crisis. It's I have a significant financial problem. That things are not going well, and I need to sit down with someone face to face and put my hand up and say I need help resolving this, and I can only do that through the branch. So it's almost, in some markets, a reaction to perhaps the negative part of the economic cycle from a cost of living point of view.
I think those are reasonable arguments, and I think there will remain a role for branches, even though I'm called, a lot of people characterize me as the death of branch guy, particularly in the US market, right? I think that we will still continue to see, branches as sort of, it'll become more of a boutique choice for banking than mainstream. But the real, if you step back from the psychology and those things you talked about there, the data shows a very different picture. The data shows a picture that we see a plethora of digital-only banks that are very able to support their customers, who are very happy with their banking experiences, that don't have any branches. And this sort of comes back to a quote I used in the book from Henry Ma, who is the CIO for WeBank, which is, of course, is the largest digital pure play bank in the world, 350 million customers. Actually, it's probably more than that now. But he said, if you need to see a human in a bank, then that's a design flaw in your bank, and I think that's, we're seeing sort of this optimization of experiences built for day-to-day banking. And yes, there are use cases for the financial issues, and I've got assets or inherited some money or whatever, where you want the comfort of speaking to a human about your banking. But that's not defensible, because AI is going to replace that capability fairly quickly. So ultimately, the sort of, I guess, the real idea or intent behind this book is, if you are reliant on branches in your business as a bank, you're going out of business. You have to be digital first regardless. And if you have branches, that means they only have one real strategic role for the bank, which is to support the digital effort and be, part of that closed loop. If you argue any other argument around branches, the data is showing, if you're relying on branches as a financial institution today, then you're going to go out of business,
No, I'm
because
not.
you
I'm not
can't survive
disputing
without
that.
that.
But if we go back into the psychology for the second, and this is going back some time, I grant you. So we know in the financial crisis, in Australia, in the UK, in the US, in Hong, yeah, in lots of markets, and this was almost 20 years ago. Important to note, there was a flight to safety. People put their money into brands that they could see were made of bricks and mortar and were on street corners, which obviously is not so prevalent now, but it goes into that issue of trust. And I remember doing some research in Hong Kong again 10 years ago for HSBC, saying, what's the number one choice when choosing a bank? It was a convenient branch. And what was the number one thing you'd like to see from your bank? And it was like more branches. And the head of HSBC Hong Kong going, you literally cannot stand anywhere in Hong Kong and not see an HSBC branch
Yeah.
somewhere. So how is that research even making sense? And when we dug into it, it wasn't that they actually wanted to use the branch. It was that element of trust. Trust is the number one thing in banking. Keep
It's
my
the
money
billboard.
safe.
It's the billboard. Yeah.
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 So
I no, I mean, that's hugely expensive though for banks.
yes, but they've
Average
got them
branch
already.
deployment. Yeah, yeah. So if they've got them already, that's fine. But even then, the economics of branching is a real challenge these days. Because even though people say that, and there is that psychological protection of having the branch, they're still not using them, right?
Yeah.
It's certainly at the same level that they were even 10 or 20 years ago. I mean, we've seen like if you take HSBC internally, and I don't know the latest numbers, but I know numbers from a few years ago. I will tell you that on average, in a market like Hong Kong or Singapore, that the average customer didn't visit the bank branch this year. So, yes, they want the security of having a bank branch, but that doesn't translate into economic activity for the bank. It doesn't translate into a deeper relationship. It doesn't translate into greater cross sales, or it doesn't, it translate into sort of more revenue, right? That's no longer supported by the data. And so, yes, you may pick up a customer because of that trust, because you've got that visibility. And I still believe there is some of that. Having said that, how is Alipay the most trusted financial institution in China? How is Nubank the most trusted financial institution in Brazil? Revolut is competing with the likes. Revolut has 50 million customers in Europe now. HSBC has 36 million globally. So these are, again, trusted financial institutions that don't have a single branch, and no VC in their right mind would suggest that Revolut needs to start opening branches in Europe to get trust, right? So you have the research does say this, but the data tells us that you can be trusted as a bank without this. Having said that, there is some legacy psychology and behavior there around it for sure.
Yeah, and I'm not disputing it. If you're building a new bank now, if you're building a fintech, you would be crazy to invest in bricks and mortar. But let's look at the incumbents, who've got 800, 1,000. I think Bank of China in China, which we'll come back to in a second, has over 10,000 branches. So you're the CEO of a bank. You've got all these branches, as we know in most Western markets. You start closing them down too quickly, and then the next thing you know, you're in front of a parliamentary committee going, you're
Yes.
reducing access to cash, you're reducing services.
Especially in Australia, New Zealand, UK, this has been a debate ongoing for years, and it is, we tackle this in the book, right? What happens in these cities, these rural locations, that lose the only branch in town. Now, the US's strategy to do this is to force banks to keep the last branch in town open, and this is the Community Reinvestment Act. But this was a law put in place in 1977.
Okay.
And, so you can't say it's actually modern regulation. It's just,
Or it's work.
it's there. And then the solution we're seeing in Australia, New Zealand, UK and so forth is the post bank solution, right?
Yeah.
Turning post offices into banks. The key problem with what you're talking about in terms of declining branch numbers in these affected communities is that banks aren't social infrastructure. They are commercial entities that have to report to shareholders. So, as a government and as community, we can't necessarily expect our banks to provide social infrastructure like a branch, the last branch in a town that's seen decline in that over years. We can't expect commercial organizations to provide that. So ultimately, either the government needs to incentivize them to keep those branches there, or they need to move to something like the post bank solution. So that was the conclusion of the book in respect to that particular issue. But We did have some really hard data on this in the Calabria region in Italy. Financial exclusion has increased. So, at a time when financial inclusion is booming around the world because of digital, because of that behavioral dependence on physical branches, you're now seeing people with less access to financial services because branches have closed in Italy. So this is a problem that is definitely worth discussing and debating, but there's not an easy commercial solution to that because the economics of branching have changed so much.
So if we are looking at potential economic solutions, is it going to be like, forgive the analogy here, kind of like airline lounges, where most people don't get to use the branch, but if you're a premier customer or a mass affluent customer, you get to and that way the branches are being tailored for the more profitable high-end services, dealing with the high-end customers, and the mass market have to go through the non-branch channels and the alternative solutions that are provided. Is that one potential future, or I mean, if you're the CEO, as you say, in Australia or the UK, and you're thinking, okay, I need to close these branches economically, but the political and social backlash is going to be so huge, I need to find some kind of interim solution. What are some of the interim solutions? Is it offering high-end tailored services? Is it offering investment only advice? What are some of the things potentially that branches could be utilized for, given all the digital channels and the arrival of Gen AI and how that's transforming banking?
Well, it's a complicated question. But I will say, if I was the CEO of a bank, what I'd be working on is I'd be working on AI that can replace the function of a human in a branch. And I'd be showing customers, you don't need to come to the branch anymore because your personal AI is going to be the best banker you've ever had. Right. And you're going to get all of the psychological support you need from that. And we'll still have some, high touch exclusive centers for our best clients. I think that is a fairly probable outcome in the future.
And how does that impact brands? Because you've got all the fintech brands which have very different brand traits and characteristics, and then you've got the big traditional incumbent brands that are, we're here. I mean, I'm pretty certain it's one of the Australian banks or one of the UK banks. We're here, we're part of the community, we've been here for 150 years. Certainly Standard Chartered are like, we've been here 150 years in this market. Look at our brand. It's so much of their brand and their market positioning and is tied up in that kind of physical network. How is that gonna, I mean, obviously that doesn't affect the fintechs and new players at all, but for the incumbents, how's that gonna affect their brand as they kind of like diminish what's been their message for a long, for decades now?
Yeah, what's their personality become?
Yeah.
When they have to become a digital bank, and that's part of the debate. Is from this point forward, you need to be digital first as a bank to survive. We know that because the metrics are fairly clear. This was a surprising part of the data. Let me see if I can find the page where this is at, but in the book. But when we looked at the top 20 retail fintechs in the world versus the top 20 banks, we got a shocking result in terms of the data. And that is that if you look at the top 20 retail players in each of those, the top 20 retail banks grew about 3% in the 5 years following the pandemic, right? So, like from 2020 to 2024-ish. And if you look at the top 20 retail fintechs, they grew by 210% during the same period, which means that by 2024, that it was estimated that there would be 4.1 billion customers for the top 20 retail fintechs versus 2.7 billion on an aggregated basis for the top 20 retail banks. So there's a very clear message here that digital utility is the way banking is being embedded in people's lives. So if you're one of these traditional banks, even if you've been around for 160 years, the fact is you have to be digital first moving forward. And this poses a fairly significant challenge for incumbents, which which the new entrants don't have, which is technical and cultural agility. Because the new entrants have brand new tech stacks, so they can integrate AI, they can do post-quantum encryption, and all of those sorts of things fairly simply because they're in the cloud and they just plug in some new tech capability. That's a 3-year project at an incumbent. In terms of cultural agility, you at a fintech, you don't have this debate over should we invest in branches versus should we be investing in digital, and sort of trying to have the budget wars internally about who gets that piece of the pie, because you just commit to digital. So we have big debate in the book about Chase, and even the other authors who contributed chapters to the book. I had this debate with them internally. I hope they don't mind me saying this, but some of them were arguing, but there must still be some relevance in branches. Look at Chase's investment in branches, right? But Chase is spending $1.8 billion per month on digital. So if they really were satisfied or comfortable that branches were going to save their business and be the future of their business, would they be investing, like it's $18 billion a year. So it's not quite 1.8 per month, but $18 billion a year in tech and digital transformation if branches were working fine? I don't think that's the case. So, you have to become a digital first organization, but that's going to be hard. So if you want to have another 160 years, although I very much doubt the banks will exist in 100 years' time, in the way that we think of them today, then you don't really have a choice. Your branches aren't going to get you there.
I want to come on to China for a second, but just before I do, one question just occurred to me. We're talking about branch usage here, and we're talking obviously about consumers. And one of the arguments for years for branches was for small businesses, but most small businesses now are increasingly not physical. And I was just thinking too, so to RFI, so when we opened offices in Singapore, in Hong Kong, in Toronto, in London, all with different national banks. I don't think I've ever been to any of the branches of those banks since I opened those bank accounts up 10, 15 years ago. As a business owner, you're incredibly time poor. The last thing you want to do is walk down to the branch with like a bag of cash and count it out and hand it over. So presumably the fact that more and more businesses are e-businesses is going to accelerate even further the argument for the branch, and that that traditional 3:30 queue as all the local businesses come in and hand over their takings for the day. That's just not going to happen anymore.
Well, we tackle the cash decline issue globally, in the book as well, because cash has been traditionally a big driver of branch activity. Of course, there are many bank branches now that don't accept cash, so that's pretty crazy, historically, to think of that. But we are seeing the platformification of banking for sure. And if you think about what running a small business is going to look like in the world of AI, think about the fact that you might have an app for banking, but that you could also be working with Shopify or Alibaba or Amazon and effectively running your business completely on their platforms. And the benefit you're going to have from that is you don't have to worry about doing accounting. You don't need a bookkeeper. It's all managed. Payments to your, invoices are issued automatically, and essentially your tax will be done automatically with AI and all of that. So all of that workload that you have, the operational overhead that you have, we expect AI to come in and really transform that. For banks, supporting SMEs, they're definitely going to have to provide behind the login that type of AI support. Your accounts will be done automatically. For all the accountants listening to this show, I'm very sorry to tell you, but we're going to see that level of automation coming in. And then for larger companies, you then get into smart contracts and you get into autonomous business operations, and that requires very different technology infrastructure from what we have at traditional banks. You're not going to run smart contracts on 1960s era banking core systems. You're not going to run them using fiat currency. You're going to be using stable coins and CBDCs and tokens, right? So, everywhere we look in this banking space, we're sort of moving to sort of technology-based architecture that will support the platform of your business. But for SMEs in particular, a lot of these new emerging platforms that you can build your businesses on will become de facto, their banks as well.
Okay, you mentioned digital architecture, and you've already mentioned WeBank and Alipay and Alibaba. So obviously need to look at China. So China, when you think of China, it's incredibly digitally advanced. And I remember, you could literally hand over money with Alipay back in 2012, I think it was, when no one else was really even thinking about that. So you think of China, you think incredibly advanced digital banking, huge rise of fintechs. But at the same time, Bank of China has 10,000 branches. So you've got this, you've got the biggest branch network in the world, and also the biggest fintech and digital banking creation in the world as well. So how's that dichotomy working and kind of playing out?
So I was just looking up the chapter on China, which Richard Turin put together, a tale of two Chinas or two nations, right? Um, China's bank branches did increase in the last decade, but have been essentially flat in their growth for the last 3 or 4 years, right? In fact, the only G7, G20 nation that has seen an increase in branches since the pandemic is India. And India's branch growth was flat in 2023, was anemic in 2024. So we're expecting that to flatten out as well. The problem with like China and India or Africa, African countries, as an example, is that they have very, very low branch density compared with countries like Australia and the US. And in fact, Australia's branch density is declining, but it's still higher than China. So there's a reasonable argument to expect that China has to catch up in terms of branch density. One of the figures that, China has 8 bank branches per 100,000 people, compared with 28.3 for the US and 25.1 for the UK. And the average branch in China serves 14,000 customers, right? So you would think that, there's a case for more branches, but China is the most digitally payments, advanced economy in the world, and will likely be the first truly cashless economy. Even though we could say Sweden is cashless and Singapore is going to be cashless soon and so forth, you don't need cash in China. In fact, dealing with cash in China is a headache now for most Chinese. And we're talking about, 98% of the Chinese population has access to a digital wallet, and 93% of them, use that functionality on a monthly basis. So, yes, you could see an argument for more branches based on the density play, but the reality is a lot of what people need branches for, they can do digitally in China, even better than what they can do in the West.
Okay, so as people go to branches for human interaction, to chat, and as we've said, that's clearly going to be replaced
When
by.
did you last go to a bank branch to have a chat with a banker?
Oh, as I said, I haven't done that for decades, but the data shows that a percentage of the market still does. In the same way, the data shows the percentage of the market still uses cash, and I cannot remember the last
This
time
is
I
why
ever
I
had
like
to use.
talking to researchers, right?
It's not survey sample of one. But yeah, I can't remember the last time I used cash or went to a branch. And as you say, if someone asks you for cash these days, it's a massive inconvenience because you just don't carry it. But coming on to AI and AI based solutions, and we were discussing this just the other day. Everybody's very excited about AI and the solutions it can offer, but then there's that concern about security, about trust, about is there a human involved in the mix, providing some QA around the AI. So what can banks do to transition? So okay, nobody's building branches, and banks are obviously looking at the economics and closing branches, but they do have to retain some, or they can only close a certain amount a year for political and social reasons. So as they look to transform the branches and reduce the need for branches, how can they help consumers overcome the reluctance that consumers have for any new technology when it comes to AI. So, rather than going to talk to a human in a branch, here's a compelling AI-based solution that will replace that for you.
I mean, look, you can introduce that type of automation into the banking app, and mobile banking apps, particularly since the pandemic, have seen a fairly significant increase in utilization. So, you can, have AI view of your financial position. You can have an AI pop up and say, "Hey, you're underutilizing this cash. You could be earning interest. Did you want me to?" You could just introduce some of that functionality over time, so the trust is there. Some people still go, "Oh, I don't trust AIs." Like, I'm never going to get a Facebook account. We see that sort of historically in terms of adoption of the tech, but like on occasion, you see things like the pandemic, which forced people into a different posture, and I think the pandemic was sort of a key data point in this research as well, because we did see people having to adopt digital at scale during the pandemic. So I'm not sure whether something like that is going to, force adoption of AI again. But I think in terms of the trust element, I think one of the things that we sort of felt out of this research was trust is changing. And, we are embodied in a world, or immersed in a world of technology these days. So the argument that people take longer time to trust technology is becoming sort of less meaningful, because there's so much technology around us, and technology adoption diffusion curves are showing that technology adoption's happening quicker and quicker all the time. But on the banking side, again, why is Alipay and Nubank more trusted than incumbents that have been there for 100 years, in their respective markets? And it comes back to utility. It comes back to the fact that, Alipay, you want to send money to your friend, or you want to pay, it works every single time. It works flawlessly, and it works at a scale that the banks can't even imagine, right? Like Pay during Singles Day last year processed more transactions per second than all of the card scheme networks combined have as their theoretical limit. In fact, more than twice the volume of MasterCard and Visa's theoretical transactional limits. And they did that flawlessly. So people trust that it's going to work. And I think that's what's happening in terms of banking. It's shifting to being about keeping your money safe and moving your money frictionlessly and all of those things. And the tech is showing that, it can be trusted at scale. Otherwise, again, Alipay wouldn't be able to work, and Nubank wouldn't have 120 million customers, and Revolut wouldn't be on track to be the biggest bank in Europe. If trust was dependent on the human element, right?
Yeah, I mean, the data shows, keep my money safe is number one, keep my personal details secure is number two, and provide a seamless and convenient experience is number three. But then, cyber security, criminal, financial fraud, scams are particularly in some markets, exponentially growing. And every time there's a scam and someone hacks in, obtains data of credit card customers and everything, you can almost feel the reaction back against that. Oh, this is because of, technology is moving too quickly. But just looking at branches for a second, and without giving away the whole thesis of your book. So there's no doubt that you would be crazy to build branches now, or invest in branches, but there is also no doubt that the incumbents have legacy branch networks, which they can't instantly get rid of overnight. So they are, over the next 10, 20, 30 years, going to need to kind of transform those. So looking into a crystal ball, at what point is there actually a point when you think branches will politically and socially be allowed to completely disappear from the high street in developed economies where there are large branch legacy networks? Or is there always going to be some element? And what is the most likely use of a branch in a Western economy, in the US, UK, Australia, Singapore, in sort of like the next 10 to 15 years?
Hmm. Yeah, it's a good question. Look, I don't think we're going to see a city like New York or London or Sydney with no bank branches by 2040. We will find that you will have much smaller branches there. So you're going to have right sizing where the square footage is declined to, like think about branches the size of a mobile phone store, right? Very small shop front type things, and then the big flagship digital, enabled platforms. As you said, the big billboard type setup. Having said that, I think if you're looking at those markets that you mentioned, we would see, in the US by 2030, we expect to see half of the branches that they had at their peak in 2008. The EU is already at that point. UK and Australia are well beyond that. UK will have less than 2,000 branches by the end of this decade, probably, a few hundred branches by the end of the next decade. That's just the trend. So if you're a banker in this environment, what are your strategies? Well, Chase gets a lot of traction in the US for opening all these branches, but part of what Chase is doing is they're closing their 5,000 square foot branches and they're opening a new branch around the corner that's 1,000 or 1,200 square foot instead. And they're saying, look, we're opening all these branches. What they are doing is they're right sizing their network. They're also, they have much better data now, so they can find out where these smaller branches should be placed for optional, deposit taking activity and, asset capture and stuff like that. So the data science is going to be important in terms of that sort of future. But again, there's in that environment, there's no data to say today that there's anything on the horizon that's going to slow the decline of branches. I don't expect with AI coming into the mix that we are going to see any data over the next 10 to 15 years that will arrest the decline in branches. So you need a strategy. You need a strategy now for how you're going to unwind branches or what you're going to replace them with, and how you're going to communicate that to your clients, and how you're going to give them a level of comfort around that. I don't know beyond the strategies that we've talked about it. I'm not sure. You could have pop-up branches, that sort of function as the billboard piece, particularly for launches of new property developments. And there's your pop-up branch with a banker who can sign mortgages for you on the spot and things like that. Using all the digital stuff. But again, ultimately, as AI gets more and more competent, a lot of the things that we used to have to go to a branch for will simply just be accessible to us through the technology layer. And that's the key problem in, we talked about the Apple store branches, a decade ago and so forth. And the core problem with thinking you could design branches that would attract people back into the physical space was that the reason people aren't going to branches isn't a design problem. It's not about the branches being inefficient or poorly designed. It's the fact that I have this and I can do so much more with that. So, you'd have to essentially, if you want to see the decline of branches stop, you have to take all the smartphones off everybody, right? So
that's not going to happen. Brett, we're out of time. Thanks very much for coming on again and talking about it. And just hold up your book one more time, Branch Tomorrow.
Branchtomorrow.com is the URL if you want to go and check it out. It is available on Kindle globally. And if you want a physical copy, you can reach out to me and we'll see what we can do. We do have some booksellers in some markets that are already distributing. We're actually already in our second print run for the book. So.
Well, congratulations on yet another fantastic book looking into the future of the banking industry. Branchtomorrow.com for anyone listening. And thank you very much for joining us.
You're welcome, Charles.
Cheers.